welcome to Market Wrap number 213. Stuart Williamson here at the helm. This week we come to you from the illustrious and exciting location of Southport, which is just near Liverpool. Basically, it's the headquarters of the 79th Group, and we're here discussing some of their innovative and interesting products. They're an asset manager and a developer, and this week we're talking about some of their commercial property ideas, which yield you a fixed return of 9% per annum, and we found to be very useful. If you want to find more information, please do go to our amazing new website, click on the information button, fill an email in. So this week we're going to cover information from the Telegraph, Knight Frank and Savills, all about what's going on post the Keir Starmer and Labour win. So before we get into that though, there's been three notable wins in the last week. Obviously England beat the Dutch last night, fantastic. At the weekend it was compounded for the Dutch again when Lewis Hamilton beat them at Silverstone. Jan Verstappen I think his name is. And thirdly we have the Labour Party winning. They've got a large majority of 174 seats in the House of Commons, which was only really reflected or recently with Boris Johnson's. Boris Johnson had the same thing, but unfortunately he was the head of the party of chaos. I think on this occasion we've got the party of technocracy or meritocracy, one of those things with Keir Starmer. Keir Starmer is very much a organised work ethic person. So I think the complete opposite of what we've seen with Conservatives. So what does it mean? General thoughts are that it'd be quite a quiet start because they're unsure of themselves. They haven't done management for a long time. Keir Starmer's never done it in a political sense. But they shouldn't lose momentum because they have a great opportunity with a large majority. And although they could be looking over their shoulders and looking at Reform UK or looking at Conservatives, if they spend the next 5 years doing that, then it'd be a wasted opportunity. I mean, there's a number of areas they could be working on fairly quickly and making real changes to the economy. You know, they could finish all of HS2, not just the truncated part from Birmingham onwards. That would give a real signal out there that they're here to make a change. They could pilot the road charging schemes I've talked about, which is basically where you pay to go onto motorways. That would help a lot with all the problems we've give it's been so long since new motorways have been built in the UK. They could cut fees on highly skilled immigrants. At the moment the fees are high and it puts people off coming to the UK. They can move closer to the EU. The EU is the UK's biggest trading partner in the world. You know, moving away from it is not the answer really. You know, we don't have to be part of it, but we can still leverage our proximity. Give the power for spending, for building new roads, for taxing new roads to the leading cities, and that could well make a difference. So these things perhaps they should do, whether they do or not, who knows. So using these sources of research, what is the economic outlook? As we know, the Bank of England's 2% target for inflation has been reached. The MPC's held rates at 5.25%, but it is expected they will cut later this year. And interestingly enough, Capital Economics forecast they'll go further than that, and that we will be having 1.5%, not 75 basis points, cuts by next year, and we could be looking at 3.5% interest rates. And that's Capital Economics, who are a well-known research house with no axe to grind. So possibly very positive. Housing market performance, you know, last week we reported it that Nationwide are saying stable house prices, 2% rise in June, probably 1.5% up for the year. Mortgage rates will fall. Agreed sales at 8% from March to May, but well below the benchmark. After that, because of the election, people are saying we're going to hold off a bit. So really, housing market performance is pretty stable, a bit boring really, you could call it. Look at the prime markets. Central London saw a price decline of 0.4%. Other prime markets saw it easing as well. So it's not going that well in the big markets, it's the prime markets. The point to look at is what is going on around the UK in general. You know, we are seeing reports come out that Leeds, for example, the second highest financial services employer after London in the UK, will have something like a 25% plus growth. And we have this research. If you'd like to share it, just ask for it in the comments. The Northwest should do a similar sort of thing over the next 5 years. Manchester is still powering ahead. Birmingham, although indebted, and we were there yesterday, there's a lot of Commonwealth and council buildings for sale as they're trying to cover the debt that they've run up and been bankrupted over. You know, Birmingham still has a lot going for it because of the HS2 and the fact they are redeveloping the city. So regionally is what we need to look at, not specific prime markets, how they're doing. And rents are still going up considerably in the regional markets. From a savings and pensions perspective, this is from the Telegraph, expected rate cuts would lower savings rates, so getting a favourable rate now is a good idea. Labour's tax policies will keep thresholds frozen until 2028, which will push more savers into higher tax brackets, so there will be taxation by creep. Pensions, annuity incomes currently high, expected to drop with falling interest rates. Labour reassures no immediate threat to retirement pots, but potential reforms could include changes to pension contribution relief and the annual allowance. There's no doubt at all that the high net worth pensions that are out there will be attacked again. And if you look at the disparity here in the UK of the haves and have-nots, perhaps that isn't such a bad idea after all. Other considerations to look at, non-dom and tax policies. They're talking about bringing an extra 1% in on stamp duty for people who are non-UK resident buying property. They're talking about adding extra tax to non-doms, which will deter non-domicile people from coming here. It looks like they're going to keep the stamp duty level at the same level, 300,000, going forward and make that permanent. Let's hope they do. Reintroduction of VAT on private schools and changes to capital gains tax. These things are bound to happen. The Labour Party has to get a lot of tax on board if it is going to make a lot of these changes. How it would affect us from an expatriate perspective, more stamp duty for sure. Over and above that, unless you have a big pension pot in the UK and you have savings in the UK, then you wouldn't be overly affected. There may be rent controls coming in, but we've seen how rent controls have not worked in Scotland. They have not worked in Paris. We've got more people, in France rather, more French people than ever showing interest in London and Manchester, Birmingham than ever before, because they're trying to get out of that punitive tax environment. So what actually happens is you're not getting more tax in by having rent controls, you're pushing more people away who are going to other markets, which is not what we need. Rent controls may be on a zonal basis, i.e. are they high in a certain area, abnormally high? That may be the case. Over and above that, what's going on with house building? They've all promised to build heaps of houses. Labour said they'll build 1.5 million homes, so that's 300,000 a year for the next 5 years. If they manage that, then it'll be the first time ever. Renters Reform Bill is likely to be revived, and no-fault evictions will go, as well as bidding wars. So, in summary, there is much fear existing in the non-dom and high net worth world. Is it justified? Britain's been led by the Chaos Party. You know, Boris Johnson's majority in 2019 was supposed to give him 10 years of power, and it gave him 5 years of complete mess, complete chaos. I mean, look at the overreaction of Kwasi Kwarteng on the budget that he put out. You know, you need some security and constancy, and I think Keir Starmer is such a boring individual. He will bring that. He's a technocrat. That approach has been proven. That's how he got his knighthood. If he does it calm and steadily and gets stuck into it straight away, property shouldn't be affected. The economy and GDP productivity will increase. He's talking about taking a Biden-esque approach of a bit of interference like they are doing in France, but not nationalisation, just getting new jobs in like the correct sectors to be built up and giving grants to do that. That will lead to improvement in, as I said, productivity and GDP, which means what will happen? The economy will recover. House prices will continue to go up. So longer term, it's still a good thing to be buying property. Short term, there may be some worries, but not if you buy the right sort of property. So there we go. That's Market Wrap number 213. Stuart Williamson was at the helm. We're here in Southport. It's a lovely place. The people are lovely. We've had a great time so far. Birmingham was great as well. Thank you very much for watching. Do comment, like, and say what you think.